topics today will be how to use retirement account and home equities to do real estate investment. Most people who are employed in this country have individual retirement accounts. And also some people have Roth IRA, Roth individual retirement account. We're going to focus on today because it is more useful. The regular individual retirement account is taxed when you reach 70 years and a half. You start withdrawing your money, but you are taxed at that level. Remember, now you're receiving retirement account, which is Social Security. Then you may have some side work you're doing. Then adding it to this retirement account, your tax burden may be high for you, especially if you have lost your spouse who is not helping anymore. Your spouse, Social Security plus yours plus then gives you a high burden. So we're going to focus on the Roth IRA. The Roth IRA is paying tax on egg instead of the chicken. When you pay tax, when I say pay tax on egg instead of on the chicken, what I mean is once you have convert your retirement to Roth, it means he has paid the income and they paid the tax already. So anytime you are withdrawing money from that Roth IRA, you never pay tax ever. So it's better to do that so that when your money increases with the investment you have done, you can be in millions and you don't have to pay tax ever. So we're going to go through that. So you can transfer money from one Roth IRA to another Roth IRA because you may be working for two people, you worked in two places, you left the place and you work in another place. So you may have multiple Roth IRAs in different places. You can combine them together. But if you don't combine them, you can still transfer funds from one Roth IRA to another Roth IRA. You cannot transfer a regular IRA to Roth IRA because they don't match. One has paid tax, one has not paid tax. So you cannot match, you cannot transfer funds from one to another. You can start withdrawing your money from Roth IRA tax-free once you have reached 59.5 years of age. Or second method is if you are disabled, you can start withdrawing earlier than the 59. The third one is if you want to buy investment, if you want to buy a first-time home, first-time buyer, can use $10,000 from your Roth IRA to put the down payment for your business, for your home. The fourth method is if you're dead, the fund, the beneficiary now will start getting your Roth IRA. So the beneficiaries are your spouse or your children or your grandchildren, depends on your will. So they can start getting the benefits. Your IRA can be inherited, can be transferred, and you do not pay tax, as I said, forever. If you withdraw money from your investment for expenses, now you can withdraw, suppose now you reach 59.5. Now you can withdraw any money from there for any investment. You can do any real estate, you can do other stock, other investment you want with the same money you withdraw. It's up to you. You can use it for your food, you can use it for your anything, other expenses you want, tax-free. Okay, then the next thing we have, we're going to Roth IRA. Can you wait? Do you have to, okay, if you open up Roth IRA, when can you start withdrawing money? You can start withdrawing money after 5 years of opening the Roth IRA, after 5 years. But definitely, if you older than 59 and a half, you can. But before 5 years of investment, you're not supposed to touch it. If you touch it, you have a tax penalty for that. Okay, we're going to discuss what they call qualified retirement account. This is not well known by many people. Is what the rich people use. They call it, they nickname it qualified retirement account. So if you have a business, if you have you're self-employed, you have limited liability, you have C corporation, you have S corporation, and you are doing business, you can open qualified retirement account. So now you are self-qualified retirement account. You are the employer. You are the employee. So you're wearing two hats: the employer, the employee, and you should not have employer. Your employer should be only part-time. They should only make less than 1,000 hours a year to qualify for qualified retirement account. If the person is making more than that, you are disqualified. So preferably to you alone having one single person business. But if you want some help, the person must be part-time. They cannot work full-time. Otherwise you're disqualified. You can, the best thing about this qualified account, you can deduct up to more than actually 119,000, over 100,000 each year on taxes from qualified retirement account. Because at that time, especially if you're over 50 years, you're doing a catch-up, you have regular you remove your own as employer, employee, and then the spouse as your spouse. So when you add both of you, you're getting more than $100,000 free from the government that you're not paying taxes. That's why many people don't know about this. This is for, that's why they call that name. Many people don't know what it is. If most of you watching this may never ever know what it is called, unless you start reading about it and find out what for retirement account. That's why it's not familiar. Not like IRA, SEP, COVID, so many other things people know. This is completely very, very exclusive retirement account. Okay, so it's okay. So as I said here, you can borrow up to $50,000 if you have an emergency. You can borrow $50,000 from this account. Only part-time employee, as I said, and then you can write your check. You can control your investment. See, the Roth IRA and the regular accounts, you have equity companies holding on your business. We're going to see that later. I'm going to show that later. They are holding your account. You can't do anything about it. When you want to do investment, you have to go through them. Or with the qualified retirement account, you have access to the check. You can manage the account. You write the check yourself. You respond. This is the best one actually to use for real estate investment. The other ones is very hard because the company that's holding your money may not release that money, especially if the market is hot. The market is hot, you need to make a decision now, not tomorrow. The other one, it takes days for them to wire the money to the place, and by that time, somebody else has purchased the property. This one is, you have the check, you make negotiations, you wire the money yourself without wasting time. You can use it for various methods, and it's really beautiful. plus that you get up to $100,000 each year from the taxes, and you can borrow money from your money. That's beautiful. So let's do the other. The next one we're going to go. If I have problem getting back, but bear with me. We're going to go. Let's see. Okay. The next one we're going to say. Somebody say, "Can your children and grandchildren have opened up IRA account?" Absolutely. The answer is absolutely yes. All they need is Social Security number. Once that child reaches 2 weeks or they have got your Social Security, you can open up IRA account for them. I prefer you open up the Roth IRA. As I was saying, a Roth IRA has so much benefit. So open up Roth IRA for that child. So how can the child open up Roth IRA? Remember I said this end salary, end money. So somebody must pay that child. You have to employ your child. So your child is employed, you open up an account for that child. The child may be doing advertisement for you, and you're paying the child for the advertisement the child is doing. Then a little grown-up ones may be doing maybe cleaning the place for you, making coffee, but they employ them. They are doing many things children can do in the work on their office, on weekends or after school. Even if they do 1 hour, 2 hours, it doesn't matter. You still pay them salary for what they're making. So that salary is placed into the child's IRA. With that IRA, the child can borrow money from that, transfer it to the escrow company. The escrow company will do the investment itself. So when the profit comes, the escrow company wires the money back to the equity company. The money will never go to the investor. The money will not go to the parents. No other person touches the money except the equity company holding the money to the closing company, closing agent, or the attorney. So the business is done very clean, and the child's money grows fast. How much do you need to open up the account? You can open up the what do you call? Okay, that's a different one. We're going to discuss that. When you're opening the account, make sure what they really need is at minimum $200. However, if you use only $200, but next month continue contributing money to that account. So even if you use $200 to open it, next month, based on the child's salary, continue paying into that account. The money will keep growing. And if you do investment that generates 18%, 24%, that child's account will grow very, very fast. So what other type of account can you open for the child? People call it for this. Your child is going to school and you want that child to have some money before they go to school. So they call it Coverdell, Coverdell, Coverdell account. So the Coverdell is for students going to school. So you need $2,000 to open up that minimum maximum of $2,000 contribution to open up the tuition account for the child. It has to be before the child reaches 30. So when the child is going to college, the things that qualifies for that money are tuition, books, housing, travels, special uniforms. Because some schools may need some special uniform, otherwise your normal shopping clothes doesn't qualify. So it has to qualify for you to use that money for your expenses. So after the child has graduated from the school, the remaining money can be used for another, if the child wants to go to graduate school, wants to go to another thing, that's the money for the child. You can still use the money for any other thing. But the child may qualify for other things, scholarships and other things that may not need that money that you paid, but the money can be transferred to another child. So it doesn't have to be for that child only. Any of your children can use the money until the child reaches 30 years. After 30 years, that account does not qualify for the covered account anymore. Can you open up an account for your mom, your grandmom? Absolutely, you can open up account the same way we open the Roth IRA. You can open up Roth IRA for your mom or your grandmom. You pay them salary. When you pay them salary, you can use it to maintain them, their clothing, their feeding, their housing. All those things can be coming out from the grandmoms or the mom's IRA account. Why am I emphasizing about this? Why IRA account? What happens is the IRA account, when you donate, when you contribute money to the IRA, that money will be deducted during your tax when you are filing your taxes. You deduct all this money. That's the benefit. But many people don't know how to do all this. What happens? Let me give you instances. For many people, your child wants to have a birthday. You go and buy everything you want. You buy this, you buy that, you buy this, you buy that. With your cash, and cash. And the child wants to buy a bicycle for birthday. You go and use your cash to buy a bicycle. Then when they reach 18, maybe 18, 17 years, 18 years, they want to buy a car. You run to the store and use your credit card or your credit and buy something for that child. What are you doing for that child? You think you're training the child? Absolutely not. You're not training the child to know how to manage their money. The child has to be trained how to manage money. So they know they have this IRA account, and every expenses that you pay in them salary, every expenses that they are using their money to buy that. What would that child do? They start calculating, do I really need this toy? Do I really need this? If I don't need it, why not wait? So they start learning how to use money. When they get married, have children, doing other things, they know how to use money. Nobody's teaching them how to use money. They learned how to use money at a young age. Okay, so I hope this helps many people. Because you say, how do children, why so many families, wealthy families, when a child reaches 25 years or graduates from university, they almost have $500,000 to $1 million already in the account. Why the other child has more, 100,000, 200,000, 300,000 loan, mortgages, everything hanging on their neck. Another child with the same age, because they did what they learned. Their parents went to school, not a university. University doesn't teach you how to make money, but they teach you how to get the degree. But the other people went to the school of finances, how to make money when they are still 1 month. They start making money. When they reach 20 something, they are millionaires. That's the difference. So if you have not done that before, a child should be listening to these videos, listening to these messages, and start following the instructions. They are for you to learn. Millionaires are not different from you. You can be millionaire too. Okay, let's see if we can get to the next topic, the last topic. I can get then. The next topic we're going to discuss is using home equity. Are you posting seeing the screen, right? People see the screen? Okay. Okay. So if the next topic is okay, you saying that it's okay. So when there's a question, home equity, should you use home equity to buy investment properties? Should you not use, or should you not try that? Should you not try that? So there are two questions: should you or should you not? So my take, my take on this question is you can have two people having these different ideas. So what I said is, if you are single, making the decision is very easy. If you're not single, it is not easy. If you're single, you can make a decision and bear it, no matter what happens. But if I'm single, and if I see something and the investment margin is very good, investment we are very high, the profit margin is high, I would take the risk and invest on that. But if the profit margin is low, very, very cautious, very, very cautious. It doesn't make sense. Okay.
Yes, sir.
Okay, let's go back to disable. Okay, sharing screen and host to disabled participants here now. Okay, let's see. Now sharing the screen anymore. Okay. Okay, it's not sharing. Okay, it's blocking me from sharing the screen. Okay. Doesn't want to share the screen anymore. The host participant screen is sharing. No, I don't want to disable. Okay, now okay. Okay, let me continue. It's not showing the screen anymore. So what happens if you're married? As I was saying, if you're married, it's difficult to decide if to use your home equity to buy a property or not. But the example I'm giving is, if you have property that is giving you're doing investment that is short term, you're pulling money to buy something that is very short term, and you're going to make good money. Why not? It's okay to do that. No, what is it? Speaker gallery. Okay, let me go. Okay. This is giving me some problem here about the screen sharing. Anyway, Michael, can we use a full screen because it's not sharing? It's not more doing the screen sharing. Are you proceeding me?
Yes, we
If
can.
Okay, that's fine. Okay, that's fine. So what we're saying, if you're no more, you are married, what you do, you decide if you do investment like this, I use tax lien, where you're making a percentage of 18% to 24%, and it's a short term. So you see a deed that is a high price, and you're buying it low. What you do is go ahead and buy that deed because you can put it back in the market within some weeks. Within 1 week, 2 weeks, you sell it again and make over 200,000. Why not pull out money from your house and use the equity from that house and buy some property? So suppose you pull, another one is, suppose you pull up $300,000 to put down for 15 units apartment, that is 1 million, and the down payment is 300,000. You pull up 300,000 down there, invest in 15 units, that is paying $1,000 a month. So each month you're making $15,000 minus the mortgage and the expenses. So in those such cases, yes, you should use your home equity to invest. Where you should not invest is if you have something like land, that land is not producing money. Land is going to stay there for years before it produces a profit. So be careful investing under such a thing with your home equity. So decision. You have to know what you're doing. If you don't know what you're doing, following the Nashriver, they can guide you. They can review what you have and see if you should jump in or should run. So that's why we are available to help people who want to do investment. If you are with us, guide you. You can invest. Something that you should not do, we tell you, don't do that. If you can, we'll tell you to continue. So home equity is very good to use. He went to a tax deed bid, and there's a $1 million. There's a property that's after review. After a review, value is 3 million, and the starting bid is 1 million, and there's no other person there except you. So you buy the $3 million property for 1 million. What is the problem pulling out $700,000 from your home equity to buy $3 million investment? So there's a positive things about using your home equity to do investment. Okay, so those are the main things using tax shelter. Okay, so when we go back to the first one you asked about the retirement account, remember, if you're using retirement accounts, those companies will not like you to really borrow your money or dose your money. And many times you have to know, you have to tell them to put that money into investment. Otherwise it stays there making nothing for you, because if you don't tell them anything, they will not do anything. They will not invest your money unless you tell them where to invest your money. So when you send the money to them, you see the beneficiary says doing business with that company. So your name is there, but it's there as a maybe a trustee. But the main beneficiary is that company. So many people may have that money in the area, and they may never use it, and they may not even tell their family. So all your account in the retirement account is usually for that company. So I advise you to be looking into that. Always check your area account. If you worked for somebody before, you have it, but you may not know because nobody's going to contact you. They'll not tell you anything. You have to go into. If you need some help, let us know They will tell you how you should get into those accounts, how to move them out into fund that you can manage, self-directed fund you can manage. As long as it's not self-directed, you cannot do anything about it. The money stays there. Even if you reach 65, 59 and a half, they will not tell you what is up to you to know that you should start getting money out. Whatever you then get out belongs to them. I hope this helps you to know for sure all your money that you have some other places. That equity is money you have stopped there. You don't know you can use to grow your business. And then the retirement account is a lot of money you know that you don't know that you can use. That's what the conference was. And make sure you use the money you're supposed to use. They're there for you. Thank you very much.